Welcome to My Best Wealth. I'm Ryu. Today we walk you through the largest IPO in history, SpaceX, a single company worth more than the entire economy of a country like Spain, so you grasp how big this story really is.
Hi everyone, I'm Naomi. But careful, the price the market is asking for SpaceX only holds if one giant bet pays off. The bet on artificial intelligence. Today we walk you through why this IPO is different from anything you've seen before.
There are numbers that take your breath away. A single owner holds almost all the voting power, and there are three very different businesses living inside the same company. Are we looking at a historic buy or the most expensive overvaluation in today's market? Naomi and I break it down with you.
Controlled spoiler, independent analysis points to the price being high, but there are variables that could change everything. We're walking you through the full analysis next.
Imagine, for just a second, a company that's so massive, just so incredibly sprawling, that its proposed valuation is literally larger than the entire gross domestic product of Australia.
Right. Or Spain, or, Mexico.
Yeah, exactly. We are talking about an entity that doesn't just, build products. It builds literal infrastructure for the human species, both on this planet and supposedly off it.
Yeah, that's the pitch.
But here's the catch. Imagine that same company is telling Wall Street that for its leader to get his full payout, they don't just need to hit, a standard revenue target.
Right, which would be normal.
Yeah, but instead they need to establish a 1 million person colony on Mars.
It's wild.
It really is. So today we are taking a deep dive into the financial engine of the largest initial public offering in human history.
And, it is a scale that almost entirely defies traditional financial gravity. When you look at the S1 prospectus that was made public on May 20, 2026, you are not just looking at a corporate filing.
No.
You're looking at a blueprint for a parallel economy.
Exactly. And that's why if you hold any major index funds, or if you invest in tech, or frankly, if you just live in the modern world and use the internet, you need to pay attention to this deep dive today.
Absolutely.
Because the Space Exploration Technologies Corp IPO, which, is better known to all of you as SpaceX, is about to fundamentally rewire the market.
It really is.
We have the S1, we have the analyst models, and we have the raw operational data. And our mission today is to just, take all of that and figure out how this machine actually works.
Stripping away the mythology.
Yeah. So let's start with the sheer size of the hook here, because they are targeting a $1.75 trillion valuation, aiming to raise $75 billion in cash.
Yeah, and to ground that in historical reality, the previous record holder for the largest IPO ever was Saudi Aramco.
The oil monopoly, right?
Right, the state-owned oil monopoly of Saudi Arabia. And this SpaceX offering is 2.5 times the size of the Aramco debut.
Wow, 2.5 times.
Yeah, but the most staggering metric isn't even the total valuation. It's the premium investors are being asked to pay.
Okay.
Based on their consolidated 2025 revenue, the company's going public at a 94x revenue multiple.
Okay, hold on. A 94x revenue multiple. If you are new to market mechanics, a revenue multiple is essentially how many years of the company's current sales it would take to equal its total price tag.
Exactly.
So at 94x, you are paying $94 for every $1 the company brings in today. That is, that's not just aggressive. That feels like pricing in science fiction.
Which is exactly why we have to strip away the hype. We cannot get caught up in the mythology of the founder or, the sci-fi aesthetics of the rockets.
Right, the shiny objects.
Yeah. If we want to understand how a single entity commands a $1.75 trillion price tag, we have to look exclusively at the structural math and the mechanical facts of the filing itself.
Right. So let's build the foundation first. Let's look at the infrastructure of the deal, the actual filing facts.
Let's do it.
If you want to find this on your brokerage app, the stock will list on the NASDAQ under the ticker symbol SPCX.
SPCX, right.
And mark your calendars, because the market debut is officially set for June 12, 2026.
Yep.
But I really want to pause on this $75 billion capital raise. How does the market physically absorb $75 billion in a single Friday morning without completely breaking the plumbing of Wall Street?
Well, it requires an unprecedented syndicate of underwriters.
Yeah.
When a company goes public, they don't just put their shares on a digital shelf and hope people buy them.
Right. It's not a bake sale.
Exactly. They hire investment banks to act as underwriters. And these banks essentially buy the shares from the company and then resell them to the public. taking on the risk of stabilizing the stock price in the process.
Okay.
For SPCX, there are 21 underwriters handling this massive float.
Wait, 21? Usually you see, what, maybe 3 or 4 leading a big tech IPO?
Yeah, exactly. But to float $75 billion, you need the combined balance sheet and distribution network of virtually every major Tier 1 investment bank on the planet.
That makes sense.
The filing lists heavyweights like Morgan Stanley, Bank of America, Citigroup, JP Morgan Chase, and Goldman Sachs leading the book.
So all the big ones.
All of them. They're building a financial dam, essentially, to control the release of this massive ocean of capital, ensuring the market isn't flooded and the price doesn't immediately collapse upon trading.
Well, you know, the part of the syndicate structure that absolutely blew my mind when I was reading the S1 was the allocation strategy.
Oh, the retail side.
Yes. The filing states there is a 30% retail allocation.
Yeah, that's huge.
It is. That means a significant chunk of this offering, up to $22.5 billion, is aimed directly at everyday investors. You, me, the person listening to this on their morning jog.
Right.
Usually the big banks hoard the best IPO shares for their massive institutional clients, like the pension funds and hedge funds. Why is SpaceX carving out 30% for regular people?
Well, it is a highly calculated move. And it really speaks to their unique market position. Managing a $75 billion raise is historically uncharted territory.
Totally.
So by setting a 30% retail allocation, they're leveraging something traditional infrastructure companies just don't have, which is massive consumer brand momentum.
Oh, I see. Because everyone knows SpaceX.
Exactly. People know what a SpaceX rocket looks like. They use Starlink internet at their cabins. By opening the floodgates to retail brokerages, they ensure the float is fully subscribed, which drives up early demand.
Right.
But strategically, it also decentralizes a massive portion of the shareholder base right out of the gate.
Making it harder for like a single activist institutional investor to accumulate enough shares to cause headaches for management.
Precisely.
Wow, it's basically weaponizing their fan base to stabilize the stock. That is fascinating.
It's very smart.
But I guess it brings us to the most important question of this entire deep dive. What exactly are you, the investor, actually buying? Because if you think SpaceX is just a rocket company, you are a decade behind the curve.
Yeah, that is the core realization you need to have when reading this S1. SpaceX is no longer one business. It is 3 entirely different massive businesses stapled together under one corporate umbrella.
Okay, so let's break that down.
You have to look at their consolidated 2025 revenue, which is $18.67 billion.
Got it.
That top-line number is a cocktail of 3 distinct operational segments: connectivity, space, which is the launch business, and artificial intelligence.
Let's decompose these businesses, and I want to start with the connectivity segment, specifically Starlink. Because when you look at the raw data, this is the absolute beating heart of the company right now.
Oh, without a doubt.
In 2025, Starlink generated $11.39 billion in revenue. That is $11.39 billion.
And we cannot stress this next number enough, because revenue is just money coming in. Profit is what actually matters. Starlink didn't just generate huge revenue, it posted an operating income of $4.42 billion.
That is a massive margin.
It really is.
Yeah.
When you sift through the complex financials of the S1, you realize that Starlink is the primary profit engine. It is the cash cow that is funding the wild ambitions of the rest of the company.
To understand how they are making $4.42 billion in operating income, you have to understand what Starlink actually is, because it's fundamentally different from traditional satellite internet.
Yeah, very different.
Historically, satellite internet was terrible. You were bouncing a signal off a satellite in geostationary orbit, which is about 22,000 miles away from Earth.
Right, way out there.
Yeah, and it took forever for the signal to travel that distance, which resulted in massive lag or latency.
Correct. The physics of distance were the limiting factor, and Starlink solved this by utilizing low Earth orbit, or LEO.
LEO, right.
Their satellites are only about 300 miles above the Earth. So the physical distance the signal has to travel is a fraction of legacy systems, which means the latency drops to levels comparable to terrestrial broadband.
But because they are so close to the Earth, each satellite covers a much smaller geographic area.
Exactly.
Which means to cover the whole globe, you can't just launch a couple of big satellites. You need thousands of them.
Thousands and thousands.
And the S1 confirms the sheer scale of this net they've cast around the planet. As of early 2026, they boast 10.3 million subscribers across 164 countries.
Unbelievable scale.
Yeah. And to service those 10.3 million people, they operate a constellation of approximately 9,600 satellites.
And the competitive mode here is entirely built on vertical integration. Look at their rivals. Amazon's Project Kuiper, despite having over $10 billion in backing, has barely a fraction of that hardware in orbit.
Really?
Yeah. And Eutelsat OneWeb has roughly 600. SpaceX is winning because they don't have to hire a third party to build their satellites, and they don't have to hire a third party to launch them.
They just do it all themselves.
They design, manufacture, and launch their own hardware. And that structural cost advantage is why Starlink's revenue grew nearly 50% year over year from 2024 to 2025.
But I did notice a really interesting trend in the unit economics. The volume of subscribers is exploding, but the amount of money they make per subscriber is actually dropping, right?
Yes, and that is a crucial nuance for any investor to understand.
Okay.
The S1 reveals their average revenue per user. The ARPU has been steadily declining. It was $99 per month in 2023, dropped to $91 in 2024, hit $81 in 2025, and in the first quarter of 2026, it fell to $66 per month.
So why is that happening? Are they just slashing prices because of competition?
Not necessarily. It is a reflection of aggressive international expansion.
Oh, I see.
When you expand service into emerging markets across Africa, South America, and parts of Asia, the local purchasing power is significantly lower than in North America or Western Europe.
Right, they can't charge $100 a month everywhere.
Exactly. They have to introduce lower-priced service tiers to capture that market share. So while the revenue per individual subscriber drops, the sheer volume of new subscribers in these 164 countries is doing the heavy lifting to keep overall revenue and profit climbing.
Okay, so Starlink is a cash printing machine, which begs the question, where on earth is all that cash going?
That's the billion-dollar question.
Because it's definitely not sitting in a savings account gathering interest. It's being literally strapped to rockets and burned in their second business segment, the launch division.
Right, and this is the business SpaceX is most famous for. The Falcon 9 rockets landing themselves on drone ships.
It's so cool to watch.
It is a modern engineering marvel. I mean, they literally launch 80% of the world's payload to orbit. They have a 99% mission success rate.
And yet, despite launching 80% of everything that goes to space, the filing shows that in 2025, the launch segment posted a negative $657 million operating loss.
Yes.
They are dominating the global space market, and they are losing over $500 million doing it. How does that make sense?
Because the loss is entirely intentional. It is heavily engineered.
What do you mean?
The launch segment's negative operating income is driven by one specific thing: massive reinvestment into the Starship vehicle program. The S1 shows that in 2025 alone, they funded over $3 billion in research and development for Starship. The launch division is essentially acting as an R&D loss leader to build the ultimate delivery network.
Wait, we need to be very, very clear on terminology here because I don't want anyone getting confused by the branding.
Good point.
When we talk about Starship, we are talking about the physical rocket, the massive skyscraper-sized next-generation launch vehicle. We are not talking about Starlink Mobile, which is their direct-to-smartphone cellular service.
Right.
Starship is the delivery truck. Starlink Mobile is the package inside the truck.
Exactly. And the reason they are willingly taking a $657 million loss to develop Starship V3 is because it is the necessary catalyst for deploying all of their next-generation orbital assets.
Ah, okay.
You see, the tyranny of spaceflight has always been the rocket equation. For decades, launching things into space meant building a multi-million-dollar vehicle, using it once and letting it burn up in the atmosphere.
Right.
It was like throwing away a 747 airplane after a single flight from New York to London.
Which is just crazy when you think about it. The Falcon 9 changed that by making the first stage reusable. But Starship V3 is designed to be fully 100% reusable rapidly.
Precisely. If Starship V3 achieves its design goals, it offers a step function change in payload capacity and launch cadence.
Meaning?
Instead of launching a few dozen satellites at a time, you can launch hundreds. Instead of waiting weeks between launches, you can launch multiple times a week.
Wow.
They're intentionally suppressing their current profitability to fund the foundational architecture required for everything else they want to do over the next 20 years.
Which brings us to the third segment of the business. And honestly, this is the segment that drastically changes the financial profile of the entire S1.
Oh, completely.
If SpaceX was just Starlink and rockets, we might be looking at a completely different valuation. But in February 2026, SpaceX fundamentally mutated into an AI company by absorbing XAI.
Now, this was an all-stock transaction. They absorbed XAI at a massive $250 billion subvaluation.
$250 billion.
Yeah, and by merging xAI into the consolidated corporate structure, they completely altered the financials. We just talked about how Starlink made $4.42 billion in profit and Launch lost $657 million.
Right.
While the newly formed AI segment carried a staggering negative $6.35 billion operating loss.
That is an astonishing cash burn rate. It is literally a financial furnace. Where is that $6.35 billion actually going? I mean, you can't just spend that on software engineers no matter how much you pay.
No, you can't. It is going into physical infrastructure.
Hardware.
Exactly. Artificial intelligence at the frontier level is not just code, it's heavy industry. It requires tens of thousands of specialized GPUs, massive cooling systems, and an incomprehensible amount of electricity.
Right.
The AI segment consumed $12.7 billion in capital expenditures in 2025. And in just the first quarter of 2026, that CapEx accelerated to $7.7 billion in a single quarter.
They are building terrestrial AI compute infrastructure at a scale that is genuinely hard to wrap your head around. I mean, the S1 details their Colossus and Colossus II data center facilities in Memphis.
Yeah.
These facilities collectively draw approximately 1.0 gigawatt of compute power.
To put a gigawatt into perspective, a typical large-scale commercial data center might draw 30 to 50 megawatts.
Okay.
1 gigawatt is 1,000 megawatts. That is the equivalent power draw of roughly 750,000 homes.
Wow.
It is the output of a nuclear reactor, dedicated entirely to powering the servers training their AI models. And the engineering speed is remarkable. They brought the first cluster online in just 122 days.
But this massive infrastructure build-out leads us directly to two of the most fascinating strategic deals buried in the fine print of the S1.
Yes, the partnerships.
The first deal is on the AI side with a company called Anthropic. And when I read this, I literally had to read it 3 times to make sure I understood the paradox of what they are doing here.
The Anthropic deal is a masterclass in infrastructure economics. In May 2026, SpaceX entered into a cloud services agreement with Anthropic.
Right.
Essentially, Anthropic is paying to secure access to the massive Colossus cluster in Memphis to train their own AI models. And the financial parameters disclosed in the filing are massive. This deal provides incremental revenue between $2 billion and $5 billion annually for SpaceX.
Between $2 and $5 billion annually. But here is why I'm so hung up on this. Anthropic is building Claude, which is a frontier AI model. SpaceX's xAI division is building Grok, which is also a frontier AI model.
That's right.
They are direct, fierce competitors. Why in the world is xAI renting out its prized Colossus compute cluster to a rival?
It seems counterintuitive.
You don't build an impenetrable moat around your castle and then charge your enemy a toll to use it. They are literally providing the supercomputer for a rival to train the AI that will compete with Grok. Why do this?
Because the toll is paying for the castle.
Really?
You have to look at the sheer cost of capital. By leasing a portion of this gigawatt-scale cluster to Anthropic, SpaceX is monetizing their spare compute capacity at hyperscaler margins.
Like AWS or something.
Exactly. A hyperscaler is a massive cloud provider like Amazon Web Services or Microsoft Azure. SpaceX is essentially stepping into that arena. They are making a direct competitor subsidize the massive multi-billion-dollar infrastructure costs of Colossus.
Okay, so they are offloading the financial burden, but aren't they worried Anthropic will out-train them?
That is where the contract terms are brilliant. The agreement is terminable by either party on a 90-day notice.
Oh, wow.
This means if xAI suddenly needs 100% of that compute capacity for the next massive iteration of Grok, SpaceX can give Anthropic 90 days to pack up and leave, immediately reclaiming the hardware.
So they get the money, but keep the power.
Exactly. They are generating between $2 and $5 billion annually from a rival, effectively de-risking their own massive capital expenditure, all while maintaining absolute, ultimate control of the physical hardware.
It is ruthless asset optimization. Pay for my factory and I'll kick you out when I need to use the machines. Incredible.
Very ruthless.
Now, the second massive strategic deal in the S1 shifts us back over to the connectivity side, and it involves a company called EchoStar. On May 12, 2026, the FCC approved a $17 billion spectrum deal between SpaceX and EchoStar.
This deal is the key to unlocking the true potential of Starlink Mobile. SpaceX is acquiring the AWS-3, AWS-4, and H-Block spectrum licenses.
Okay.
The transaction is a mix of $8.5 billion in cash and $8.5 billion in SpaceX stock. Additionally, SpaceX is funding $2 billion in cash interest payments to service EchoStar's existing debt.
I want to translate the jargon here because AWS-4 spectrum just sounds like alphabet soup.
It does.
Why is spending $17 billion on invisible radio frequencies so important? We mentioned earlier that Starlink Mobile is a direct-to-smartphone service. But historically, if you wanted a satellite phone, you had to buy a chunky, specialized device with a massive antenna that looked like a brick from 1995.
Right.
You couldn't just use a normal iPhone to talk to space.
Exactly.
Yeah.
Because standard terrestrial smartphones are engineered with specific antennas designed to pick up specific radio frequencies used by cell towers on the ground.
Right.
They are physically incapable of receiving the frequencies traditionally used by deep space satellites.
So how do you bridge that gap?
You buy the frequencies the phone is already listening for. Acquiring that specific spectrum, particularly AWS-4 and H-block, is the skeleton key.
Oh.
It allows Starlink satellites in low Earth orbit to broadcast signals on the exact frequencies your standard off-the-shelf smartphone is already programmed to receive. It bypasses the handset hardware limitations entirely.
Meaning I don't need to buy a new Starlink phone. My current phone just connects to a satellite like it's a really, really tall cell tower.
Precisely. This $17 billion transaction gives Starlink Mobile the regulatory approval and the physical physics capability to offer a telco-grade service.
Wow.
It transitions them from being just, a rural backup option for people off the grid into a direct, formidable competitor to traditional wireless carriers like Verizon, AT&T, and T-Mobile on a global scale.
So if you step back and look at the board, the operational structure of this company is staggering.
It really is.
They are dominating global broadband, they have a monopoly on orbital launch, they are building nuclear-scale AI data centers, and they just bought the spectrum to bypass terrestrial telecom companies. It is a sprawling empire.
A literal empire.
But who actually controls it? Let's dive into the governance structure outlined in the S1. Because if you buy a share of SpaceX on June 12, you might think you get a say in how the company is run.
You might think that.
But you don't. Welcome to the Musk package.
Yeah. Corporate governance for a company of this scale is typically a delicate balance of board oversight and shareholder voting rights. But SpaceX operates on a dual-class share system.
We've seen this before with companies like Google and Meta, right? Where the founders hold a special class of stock that gives them more votes than the stock the public buys.
Yes, but the concentration here is absolute.
Yeah.
The S1 details that Class A shares, which is what the public will buy on the NASDAQ, carry 1 vote per share.
Okay.
Class B shares carry 10 votes per share. According to the filing, Elon Musk holds approximately 42% of the total equity in the company. But through those super voting Class B shares, he controls an overwhelming 79% of the total voting power.
So he is the ultimate dictator of the company.
Effectively, yes.
If 100% of the public shareholders, every mutual fund, every retail investor banded together to vote against a measure, they would still lose.
Every time.
You have zero ability to influence the board of directors, executive compensation, or corporate strategy.
You are a passive passenger. And the board of directors has leaned into this reality with the compensation package detailed in the filing.
Oh boy.
In January 2026, Musk was granted an unprecedented new performance package, 200 million additional shares.
That's a lot of shares.
But the vesting contingencies,
Yeah.
the milestones he has to hit to actually get those shares, are completely detached from traditional financial metrics.
I read this section of the S1 and I honestly thought it was a typo. To vest those 200 million shares, 2 things must happen. First, the company must sustain a $7.5 trillion market valuation.
Ambitious.
Okay, aggressive, but it's a financial metric, we understand that. But the second contingency requires establishing a permanent 1 million person colony on Mars.
It is stated in black and white in the SEC filing.
How does an auditor from a Big Four accounting firm even verify that? Do they send an auditor to Mars to count heads?
Good question.
What defines permanent? Is it just 1 million people visiting, or do they have to live there? I have to ask, is this a financial document or a science fiction plot?
It is the defining reality of investing in SpaceX. As an investor, you have to accept that you are buying the Musk package. The S1 explicitly warns investors that the company is highly dependent on his leadership and that his personal interests may conflict with other shareholders.
I'll say, most shareholders just want a solid quarterly dividend and steady growth, not a multi-trillion-dollar interplanetary real estate venture.
But that is the trade-off. The board has essentially aligned his ultimate financial payout with his stated lifelong philosophical mission of making humanity multiplanetary.
I see.
As an investor, you are explicitly accepting stripped-down minority shareholder rights in exchange for his visionary momentum. You are placing a bet that his historical capacity to drive engineering miracles, landing orbital rockets, deploying global satellite nets, outweighs the traditional corporate governance risks of absolute centralized control.
Okay, so you have zero control, you are funding a Mars colony, and you are buying into a company that is simultaneously printing cash in orbit and burning it in data centers on Earth.
He sums it up.
Which brings us to the most heated debate on Wall Street right now.
Okay.
Is a $1.75 trillion price tag actually justified by the math? Let's dive into the valuation debate.
This is where it gets contentious.
Because right now, you have two incredibly smart camps looking at the exact same S1 and coming to wildly different conclusions. Let's start with the bear case.
The primary anchor for the bear case is Aswath Damodaran, a professor at NYU Stern, who is widely respected and often referred to as the Dean of Valuation.
The Dean of Valuation?
Yeah, and Damodaran does not rely on hype. He relies on cold, hard, discounted cash flow models. He built a comprehensive model separating the three businesses: launch, Starlink, and AI.
Okay.
He projected future revenues, accounted for capital expenditures, and applied an 8% cost of capital to discount those future cash flows back to today's value.
And to do this, he used a Monte Carlo simulation.
Right.
For those who aren't financial engineers, a Monte Carlo simulation is basically the Doctor Strange approach to finance. You know, in Infinity War, when Doctor Strange looks at 14 million alternate futures to see all the different ways things could play out.
Great analogy.
That's what a Monte Carlo model does. It runs thousands of scenarios. What if Starship is delayed? What if Starlink growth slows? What if AI compute costs spike and gives you an average outcome? What was Damodaran's average?
Damodaran's Monte Carlo median valuation output is exactly $1.28 trillion. $1.28 trillion.
He does provide a range, right? Depending on if things go terribly or perfectly.
Yes. His projected range spans from $660 billion on the low end to $2.8 trillion on the absolute high end.
Okay.
But the most mathematically probable outcome based on his inputs is $1.28 trillion. Because the IPO is targeting $1.75 trillion, his final verdict is that the IPO target is exactly 30% overvalued.
So the Dean of Valuation says you are overpaying by nearly $500 billion. His core argument seems to be that you are paying a massive premium today for expansion options like the AI data centers and Starship's full potential that might not generate actual cash flow for a decade, if ever.
Precisely. Damodaran looks at the $18.67 billion in current consolidated revenue and calculates that the market is prepaid for absolute perfection across all three highly risky segments.
But then you have the bull case, and this is prominently articulated by Dan Ives from Wedbush. Dan Ives looks at the $1.75 trillion valuation and says, not only is this justified, it might be cheap. Why?
Ives' thesis centers entirely on the AI segment. He argues that SpaceX possesses an unmatched AI compute moat.
Compute mode.
Right. He isn't looking at this as a rocket company going public. He frames the offering as the foundational entry point for an artificial intelligence revolution, where space becomes what he calls the natural home for compute.
Okay, hold on. Space is the natural home for compute. Let's unpack the physics of what Dan Ives is actually suggesting here.
Sure.
Because earlier we talked about the Colossus data center in Memphis pulling a full gigawatt of power. The two biggest constraints on AI right now are electricity to power the GPUs and water to cool them down so they don't melt. How does putting a data center in orbit solve that?
It solves both constraints simultaneously, though it introduces massive engineering hurdles. On Earth, solar power is limited by the day-night cycle and atmospheric scattering.
Obviously it gets dark.
Right. In orbit, a solar array has access to unfiltered, unlimited solar energy 24 hours a day, 7 days a week. We have effectively infinite free energy.
Wow. And what about cooling? Space is a vacuum, so it's actually really hard to dissipate heat because there's no air to carry it away, right?
Correct. Thermodynamics in a vacuum are complex. However, if you engineer massive radiator panels and shield them perfectly from the sun, you can radiate heat directly into the absolute cold of deep space.
Oh, I see.
You bypass the need to pump millions of gallons of water through terrestrial cooling towers. If Starship V3 can lift heavy data center modules into orbit cheaply, you essentially decouple the growth of artificial intelligence from the constraints of the Earth's electrical grid.
That is mind-bending.
It is.
But let's bring it back to the math of the IPO. We keep talking about this 94x revenue multiple. If we compare this to previous historic mega IPOs, the contrast is stark.
Very stark.
Saudi Aramco debuted at a 14x multiple. Alibaba debuted at a 25x multiple. So Aramco's at 14, Alibaba's at 25, and SpaceX wants 94.
The disparity in those multiples tells you exactly what the market is doing. At 94x revenue, the market isn't pricing SpaceX on its current satellite connectivity revenue, no matter how profitable Starlink is.
Right.
And they certainly aren't pricing it on current launch contracts. They're pricing in the total dominance of unproven future markets.
And the S1 explicitly lays out how big they think those future markets are. They claim a total addressable market, or TAM, of $28.5 trillion.
Which is astronomical.
They break that down into $370 billion for the space economy, $1.6 trillion for global connectivity, and a staggering $26.5 trillion for AI and enterprise applications.
So that's the bet.
Yeah, to buy SPCX at a 94x multiple, you have to genuinely believe they will capture a massive percentage of that $26.5 trillion AI market.
And relying on unproven future markets brings us directly to the reality check of this entire document, the 38 pages of risk factors outlined in the S1.
Yes, let's navigate the hazards, because if you are going to invest in a company trying to build solar-powered orbital data centers and colonize Mars, you better read the fine print.
Definitely.
What are the most critical threats to this $1.75 trillion valuation as disclosed to the SEC?
The risk factors are exhaustive. First, you have immense existential regulatory hurdles. Despite their size, they are entirely at the mercy of the federal government.
Oh, so?
They depend on the Federal Aviation Administration for every single launch license and the Federal Communications Commission for their spectrum rights. A change in political administration or a severe regulatory crackdown could ground their entire operation.
And you also have the looming threat of antitrust scrutiny, right? I mean, they launch 80% of the world's payload. They're practically a monopoly in orbital access.
Right.
You have to assume the Department of Justice and the Federal Trade Commission are watching this closely, especially as they integrate their AI models with this massive infrastructure.
Antitrust action is a heavily highlighted risk. But beyond regulation, there's the sheer financial reality of the business model. It is intensely capital intensive.
Building rockets isn't cheap.
Building a gigawatt-scale AI training cluster on Earth while simultaneously deploying a 10,000 satellite constellation in space burns billions of dollars annually.
Which brings us to the debt. The S1 explicitly mentions the significant indebtedness the company carries. As of early 2026, they are holding over $29.1 billion in principal debt.
That's a huge burden.
It is. This includes their standard credit facility, but the really concerning piece is the massive SpaceX bridge loan of $20 billion, drawn primarily to fund the XAI absorption and the immediate data center build-out.
This raises a critical question about their capital structure and macroeconomic exposure. That debt is not free. A massive portion of it is floating rate debt, meaning the interest payments move with the broader market. When you are managing tens of billions in variable interest debt, while simultaneously operating segments like XAI and launch that are deeply cash negative, you require absolutely perfect execution.
Because if the Federal Reserve keeps interest rates high, the cost to service that $20 billion bridge loan becomes suffocating.
Exactly. The positive cash flow from Starlink is their lifeline, but it is not infinite. It cannot cover the totality of a spiraling AI and Starship CapEx program if things go wrong.
Like what?
Therefore, any execution risk if a Starship explodes on the pad and grounds the fleet for 6 months, or if they fail to deploy the next generation of Starlink satellites on schedule, could heavily strain their entire capital structure, potentially forcing them to issue more debt or dilute shareholders to survive.
And finally, the S1 explicitly highlights the Musk concentration risk. The man is running Tesla, Neuralink, XAI, the Boring Company, and SpaceX simultaneously.
He's stretched thin.
The filing admits that his divided attention, combined with the fact that he is essentially irreplaceable as the chief engineer and visionary force of the company, is a material risk to the stock price. If something happens to him, or if he simply loses focus, the entire premium of the valuation could evaporate.
With these immense risks in mind, coupled with a 94x revenue multiple, it is highly instructive to look at how other massive, highly hyped mega IPOs have fared once the opening bell rings and the initial euphoria fades.
We have to examine the historical precedent.
Yes, we do.
Because gravity usually catches up to these things, right? When you have a $75 billion float, the supply of shares entering the market is just so vast. Finding enough immediate demand in the secondary market to keep pushing the price higher day after day is mathematically grueling.
It is. Let's look at the data for 6 months post-debut.
Okay.
The historical data for the absolute largest global IPOs paints a very cautionary picture for retail investors hoping for a quick first-year pop. Let's look at the performance 6 months after the IPO date.
Right, what happened to them?
Saudi Aramco fell 15%. Alibaba dropped 9%. Meta, which was Facebook at the time, plunged a massive 38% in its first 6 months. General Motors lost 8%, and UPS declined 11%.
Wow, it's a bloodbath of red numbers for mega IPOs.
It is. Historically, among the absolute largest equity offerings, only Visa managed to meaningfully outperform the broader market in 6 months immediately following a mega debut.
So if history is our guide, the odds are heavily stacked against SPCX maintaining this $1.75 trillion valuation in the short term. The initial hype will wear off, institutional lockups will expire, and the sheer weight of the float will pull the price down.
While that historical data is accurate and the gravity of a $75 billion float is real, we must consider the counter-arguments from the venture capital space, which views this asset entirely differently.
Okay, what do they say?
Tom Tungus, a highly respected venture capitalist, specifically noted regarding this exact offering. Aramco isn't a proxy for SpaceX.
Let's unpack that. Why isn't Aramco a good comparison if they are both massive infrastructure plays?
Because they operate in fundamentally different economic realities. Aramco was a mature, dividend-yielding asset tied to a highly established, cyclical, global commodity market oil. Its growth curve was already established.
Right.
SpaceX, despite its massive size, is behaving like an early-stage infrastructure growth stock. It isn't just servicing existing markets, it is actively creating net new markets in space connectivity and AI compute that previously did not exist.
Ah, I see.
Therefore, Tungus argues, the structural selling pressures and the investor base's willingness to absorb short-term volatility and cash burn might operate very differently here than they did for a state-owned oil enterprise.
It's the difference between investing in a well that is already pumping oil versus investing in the company that is inventing the internal combustion engine.
That's a good way to put it.
The volatility profile is entirely different. So, assuming you've digested all this, the gigawatt data centers, the Mars colony clauses, the massive debt, and the historical IPO gravity, and you are watching the stock trade under SPCX on June 12th. What are the immediate milestones investors need to watch in the subsequent months?
The S1 makes it explicitly clear that the second half of 2026 is the critical crucible for the company's valuation. First and foremost, the market will be watching the successor failure of Starship V3.
Because Starship V3 is the linchpin for everything.
Exactly. The entire economic model for scaling orbital AI compute and for deploying the larger, heavier Starlink V3 satellites that are necessary to maintain their connectivity margins depends entirely on Starship achieving a rapid, fully reusable orbital cadence.
Right.
If that development timeline slips, if they have patent anomalies or FAA regulatory delays, the massive revenue projections for 2027 and beyond will have to be drastically reduced, and the stock will likely be punished.
Another major catalyst to watch is the impending lockup expiry window. For those unfamiliar, when a company goes public, insiders and early investors are usually locked up, meaning they are legally forbidden from selling their shares for a certain period, usually 180 days, to prevent them from immediately dumping the stock and crashing the price.
And the lockup structure for SPCX is highly unique and creates a significant potential volatility event between September and December 2026.
Right, because we need to clarify, Elon Musk is under a full standard lockup. He cannot sell early, no early release provisions apply to him. But other insiders, executives, and early venture capital backers, DO, have early release provisions tied to certain price targets.
This creates a massive potential supply event in the fall of 2026. If the stock performs well initially, billions of dollars in shares could flood the secondary market as early investors decide to lock in a decade's worth of private market gains. Market watchers will also be tracking two crucial external variables.
Let me guess, one of them involves the Dean evaluation.
Yes. The market will be eagerly waiting for Aswath Damodaran's reassessment.
Right.
Once actual trading data stabilizes, the initial market capitalization is set, and the company releases its first public quarterly earnings report, Damodaran will run a revised valuation model. His public assessment of whether the company is growing into its multiple or failing to justify it will heavily influence institutional sentiment.
And the second external variable.
Investors will be keeping a very close eye on the DOJ and FTC antitrust posturing in Washington. Any signal of a regulatory move to scrutinize their 80% launch dominance or their aggressive vertical integration of AI models, compute infrastructure, and telecommunication spectrum could trigger massive structural volatility in the stock.
It is truly a phenomenal intersection of aerospace engineering, global telecommunications, and frontier artificial intelligence, all wrapped in a financial structure that completely defies traditional market comparables. You are buying into a company that is simultaneously building the infrastructure for the next century of Earth's economy, while actively planning to leave the planet altogether.
It is. And I want to leave you with a final thought to ponder, something that extends far beyond the immediate financial metrics, the debt loads, or the revenue multiples of this S1.
Okay.
If SpaceX successfully executes its long-term, multi-decade vision, if they actually manage to move massive data centers off the Earth to harness unlimited solar power, utilizing the vacuum of space for free cooling to run their frontier AI models, we're no longer just looking at a telecommunications or aerospace company.
We're looking at something else entirely.
Yes. We must ask ourselves what it means for global sovereignty and data security when the cloud literally moves to the stars, existing completely outside traditional national borders, terrestrial jurisdictions, and the physical reach of any single government on Earth.
This is an analytical framework, not an investment recommendation.
And we're back. We've just seen an IPO that's unique in many ways. In size, in structure, and especially in concentration of control. A valuation debate that doesn't allow easy answers.
What matters for you? The retail investor. Getting into SpaceX may be tempting because of the story behind it, but there's a level of risk worth understanding properly before you move money.
Over the next 12 months, big things will happen that could push the price in any direction. The first launch of the new rocket, the first massive sell-off from early investors, and possible intervention from competition authorities. Worth watching closely.
And the closing line, very important. What we've shared is a framework to understand, not a buy or sell recommendation. Your numbers, your horizon, your risk. We'll see you in the next analysis. Until then, keep a cool head.